Events in the past can give us valuable insights into the origins and consequences of financial crises, giving us useful case studies of fiscal mismanagement, greed, and fear in the financial world. These historic cases can give us helpful lessons and teach us about future events alike. So let's go into finance from the past on today's Cash Concepts with me, Alex Chow. So, it's the start of the 21st century, and the tech bubble at the beginning of the century have made many investors retreat from stocks and IPOs. Bonds are still pretty safe bets, but the people are impatient, and with interest rates so low, the bond yield is next to almost nothing. So, what about mortgages? You know, the loan you take out when you buy a house. Mortgages were basically bonds with insurance and bonuses. As the lender, you get regular interest payments, which were higher than the bonds on the loan, and if the borrower defaults, basically stops paying, you get possession of the house. And at this time, claiming a house would be more than ideal, with the real estate market on the rise. But as retail investors, they don't want to be dealing with borrowers in person, so instead they turn to mortgage-backed securities. Large financial institutions, with their mountains of cash and assets, were able to buy up tens of thousands of singular mortgages. The investment banks then piled these all into a group, and sold these shares of the pie to investors as mortgage-backed securities. Investors took to the MBSs straight away, throwing their money at as many mortgages as they could find. Now, the borrowers were paying investors for the mortgages they had, through these MBSs. At this point, these mortgages for investors seemed like really safe investments. For one, they gave you higher interest payments than you could find elsewhere. Plus, in a worst-case scenario, lenders could take possession of the house, and recovering your losses was super easy in a market of rising housing prices. For another, the rating agencies were giving AAA ratings on the MBSs, and right now, mortgage debt was a sound investment. And with the heightened and almost endless demand for mortgages, lenders were happily providing the banks and investors with more mortgages, as each time they sold the mortgages on to the banks, they could loan out their money, again and again. The government was also trying to increase home buying and mortgage lending, with sponsored corporations like the Freddie Mac and Fannie Mae. So with the real estate market powering full speed ahead, investors were getting quite rich. But insurers, wanting to catch the profits in this opportunity, also jump into the wagon and start offering credit default swaps, or CDSs, which pay out if a borrower defaults. It shifts the risk of a defaulted payment from the investors to the insurers, but with large profits in sight, insurers have jumped caution and are now selling up to 10 CDSs for one mortgage. Now, even though insurers don't really have enough money to cover that, as long as the real estate market doesn't collapse, insurers are making free capital. However, this great chain of investing and free capital is starting to wobble, with the foundation of the structure beginning to seem unstable. You see, with the hyped up demand for mortgages, and the fact that lenders sell the mortgages once they make them, they've stopped caring for any risk they cause. To keep up with the demand, lenders began to loosen their standards, and they began to issue subprime mortgages, basically loans to people with poor credit scores, no stable jobs, and no feasible ways to pay off the debt later down the road. Some lenders even began using predatory lending practices, which were loans which seemed affordable at first, but soon grew to way more than the borrower could afford. But borrowers don't seem to notice and get trapped in these terrible loans. Investment banks even started providing a new investment called a CDO, or collateralized debt obligation. They were just like the MBSs, but riskier. However, the new lax lending requirements meant that demand for real estate was still high, driving housing prices further, which only made these mortgages look like really safe investments. But they weren't. The MBSs were steadily filling up with CDOs and subprime mortgages, and these toxic assets were making their way into investor hands. Even the rating agencies, which were supposedly made for the people, were, in reality, they were paid for by the investment banks, contributed to the crisis. With their incentive given from the banks, the larger default risk and the rubbish MBSs were still given AAA ratings, even though their quality and safety against default was going down and down. At this point, banks were thinking, even if this investment has a heightened default risk and the borrower does default, they, the bank, will still own this really, really valuable house, the value of which was growing steadily, right? Wrong. With all banks and financial institutions thinking like this, it meant everyone thought a default was no problem. It was, though. With the higher risk and subprime loans, borrowers did start defaulting on their mortgages like the banks had thought. They just couldn't keep up with their super expensive houses. However, instead of the bank owning a good property, it actually meant more houses were put back on the market for sale, but there wasn't any buyers for these foreclosed homes, so supply was up and demand was down, and as home prices began to drop dramatically, the real estate market collapsed. More people began to default as they faced mortgages worth more than the house they had. This led to a further decline in housing prices. Financial institutions were also caught up in the falling market. Insurers were now facing enormous payouts for the credit defaults swaps they sold, and many firms went under. Investment banks, seeing the collapsing market, rejected lenders' mortgages, and lenders, now stuck with bad subprime loans, began to sink in a pool of bad mortgages and liabilities. The banks themselves were now stuck with worthless homes and real estate. Insurers, lenders, and banks started to go bankrupt, and despite the government and Federal Reserve's attempts to keep the biggest players afloat, many filed for bankruptcy, including Lehman Brothers. But wait, there's more. It wasn't just the institutions which were hit. Investors who relied on the MBSs were stuck with bad investments, and borrowers who defaulted were faced with homelessness and bankruptcy. Even businesses who were supported by regular financing were crushed by the crisis, as investors began to put their money into treasury bonds and out of the stock market, leading to a stock market crash. And it wasn't just the US economy either. With globalization, the US economy falling meant other countries falling with it. This massive systemic failure also brought the dealings of financial institutions into light, and the Dodd-Frank Act was introduced in 2010 to safeguard investors from the unethical and dangerous practices of lenders. We should hope that we will never see another crisis alike, fueled by the greed and selfish gains for the few. And while the crisis is a thing of the past for many, let us not forget the useful and definitive lesson this case study provides.